Okay, we should be good now. Okay, let's begin watching this, and I'll tell you exactly what we're looking at, guys. Okay. Oh, we have about uh, a few minutes. It starts at 2:30. So until then, we can have a quick discussion, learn a few things, understand a few things, and I'll try to help you learn what these concepts are. And we do have a good number of people live right now, and let's do that as well. Is it good news for Indian market? We do not know that yet. We will know that very, very soon. And well, let me just continue chatting with you guys while I update it on my Instagram as well, so that everybody knows what we're doing, where we are, and they're not confused. So what we're looking at today, what the markets are pricing in, is a 25 BPS rate cut. And that's actually not a very good thing. I'll tell you why. I'll tell you exactly why. Just give me a second, I'm good to go. Well, guys, so those who are already a part of this channel, welcome to Bitcoin Hitpoint. You are the ones that should be welcoming me because I am not that much of a presence over here. However, to those who are new, this is our official English channel over here. Whatever we do it in English to reach a global audience, to reach many others that we aren't able to on the Hindi channel. And for that, let's do a simple ritual. Hello, Mr. Ankit, Milestone, Rishabh Raj, VK Edits, Rocky Sanam. Yo, what's up, Rocky? How's the pharmacy going, my friend? Amir Akhtar, hello. Hello, Abhishek, and hello, Call Me Pixel, AK Jagjit, Divyanshu Trades, TWS Bot. Nice to have you here, my friend. Greeky Traders. How are you doing, bhai? Satyam, Saurav Kumar, Dheeraj Desai, Cruel XOP, Milestone. Superb, super, super. Trivedi Meghal, Arshad Pasha, welcome. Good evening, guys. Good evening, good evening. Right now, it's 2 a.m. over here. It's 2 a.m. in where I am right now. 2:12 a.m. Scalped almost $3,400 today. What a move is expected. Okay, happy to hear that for you, bhai. Learning in sprint, keep it up, Ricky. Keep it up. Hello, hello, hello. Oh, I did place a short trade in Bitcoin somewhere around these 17,000 areas. I did short right at the start of the day, somewhere around here. These were my short areas, 17,005, and markets are doing pretty well. It did hit 17,300. And maybe we'll look to buy this at, we can place a buy somewhere here, somewhere here. Shortcuts are completely different on this, okay? That would be our buy trade. Somewhere here is where we already shorted it. Okay, and that's for Bitcoin. And when we talk about gold, right now it's going to be very, very, very volatile. And the meeting itself, it's going to begin at 2:30 p.m., as you can see over here. But when it begins, everything that you see is going to happen within it, almost instantly. So keep your eyes on that. Right now, if you want to take a few scalps based on your own risk on simple exchanges, you can do that. Every time there's a stoppage as such at bottom levels, you can start scalping around maybe to the previous zones. That would be $400 with a risk of 45, which I think is a pretty good one. Same with gold, might be decent to short over here. But guys, very importantly, uh, the news today is going to decide the fate of the world. So historically, whenever a rate cut has happened at all-time high, it has really not been good for the markets. It has really not been good for the markets. So think about this. When everybody is bullish, all right, when the markets are at a very high level, why would the Fed be forced to cut rates? When they're cutting rates, that means they're putting in more money back into the market. Why would they want to do that? It's not a good sign. That's really not a good sign. That implies a very difficult economy because you cut rates, that means you're making loans cheaper. That means you're putting more money, more liquidity into the global money supply. That means you want people to buy more. Think about it. When there's more money in your pocket, you buy more things. If there's less money, you spend it on food, you spend it on the basics, on the shelter. But when you have more money, you spend it on vacations, you spend it on travel, you spend it on uh, luxury food, you spend it on commodities you do not need. So that is only possible if the loans get cheaper. Now, right now, no, no. If that happens, what happens? Inflation goes high, right? Because if you're spending on random stuff, that means the basics are already met. Everybody is being able to afford the basics. When everybody is able to afford the basics, that's when greed kicks in. People get greedy. So if the demand is very easy to get, you make things more expensive. And when things get expensive, inflation rises. That's what inflation means. Things are getting expensive, the value of your money is going lower. In that case, if the inflation is rising, what do you want as a government? You do not want inflation to be too high. You will increase the rates so that loans get expensive. If loans get expensive, all of a sudden money is out of the market. Then you're not spending so much on random stuff, you're spending on the right stuff. Things you cannot be greedy anymore because if you're greedy, your sales are not hitting the right numbers. So you want things to get cheaper, right? So right now, inflation is kind of high. It's not under their target, that they target around 2% of inflation. Right now, inflation is about 2.9% in the US. That's the stated inflation. India has posted around 2%, but honestly, I think it's way higher than 2%. So inflation is high, and yet they are planning to cut rates. Okay, so why is that happening? Why do they want to cut rates? Because regardless of inflation being high, the economy is still struggling. Now, if inflation is high, that means there's a lot of money in the market, right? If there's a lot of money, that means there are a lot of jobs. That means everybody is able to pay their credit card debts. That means houses are for everybody. Everybody is able to afford a house, right? That's not the case. People are not paying the credit card bills. Nobody's able to afford housing. And there are no jobs. We are sitting at historically one of the lowest job numbers for America ever. So jobs are low, people are not able to pay. That solution is only possible if Fed lowers the rate. But then the market is at the all-time high and things are expensive as well. It's It's simply not matching, guys. And that's where all this confusion has started. And that's what the Federal Reserve is trying to fix. And it's not easy. It's really not easy. Well, it's a grave they themselves have dug. So we can't really do anything about it. They keep lecturing other countries about what to do, what not to do. But I do not think they are in any position to do that. There's a bit of a calm right now, but I'm pretty sure it's gonna blast very, very soon. Let's see if you have any questions. What you do when this bubble bursts, you sit on a lot of money, you sit on a lot of cash, and you invest in stocks when they get cheap. And as soon as this bubble bursts, at some point they will have to make loans cheaper because the world can't keep collapsing, right? It's not going to be a complete collapse. Loans will get cheap. Just take loans, build businesses, get filthy rich. You got to be able to take risks. That's why it's important to build your credit score. And that's why it's important to buy my credit card. No, You gotta you gotta build your credit score, guys. That's the real game. Build your credit score, wait for loans to get cheaper, take huge bloody loans, become the next Vijay Mallya, do whatever the hell you want. When do you think the markets will burst? Ideally, this happens when the Fed first cut rates. Give me a second. Okay, so we are 4.5. I'll show you something interesting. So if you look at the monthly chart over here, and if we compare it to S&P 500, for example. Okay. And let me just make this a different color. I'll show you something interesting. Uh, we have data before that. Yeah, let's try this. This is the Dow Jones Industrial Average along with the interest rates, all right? And let's look at 2008, okay? Ideally, stock markets are supposed to rise. See, a normal, healthy stock market rises, and then the interest rate rises after that to control things, right? And as soon as interest rate falls, right? When there's less interest rate, stock market is supposed to rise. And then with gradual slopes, stock market needs gradual rises. But historically, let's take 2001. As soon as the first interest rate cut hit, market took a nosedive. Okay, now let's take 2008. As soon as the first interest rate cuts hit, market took the nosedive. Look at that. These are huge dives, guys. Okay, and a similar situation happened pre-COVID, around COVID. Again, interest rates were dropped, COVID stopped, COVID went down. So again, I'm expecting something similar. If interest rates drop, the markets might collapse. Ideally, it's supposed to be the opposite because if interest rates are dropping, more money is being pumped. So if you look at the history of the world, this is what has happened. These are the interest rates. Interest rates went up. That's how it's supposed to perform. You put the interest rate up, you push the market down. It's supposed to be inversely proportional, but you see, you put the interest rates up, put the market down. Yeah, let's see. Let's see what happens today. What a brilliant wick this has made, along with gold. You asked in your story a full video on this, on the interest rate topic. Yeah, we'll do that. We'll do that as well. Why 113K is important? Give me a second. Well, it's actually 114K, not 113. Uh, Technically, these are the support areas that has recently held Bitcoin. And even if you look at the monthly chart, uh, honestly, monthly doesn't really show that much strength on the 113 part. If you look at a weekly chart, these are the areas where previously market has held for a substantial period, okay? So as soon as market pumped out of 114, it held for 1, 2, 3, 4, 5, 6, 7 weeks almost. As soon as it pumped down, immediately the first week that it closed below 114, market pumped down up to 107K, and then immediately went back up, and again it realized that it needs to close above that. So again, that's the reason why 114K around 14,113,900 can be an important level for us. That's the reason for it. Just past behavior. A short trade would be again around these highs. As soon as it takes these highs out, makes a peak outside, maybe 17, 18, 118K, somewhere around that. That's where we're looking to short it. If this all happens while he is giving his speech, that's when it's going to give you a very fast move. So gold has already formed a silly kind of a range, expecting the Fed meet. This is some liquidity takeout. Hit the like button, make it 501. Are we at 500? What? I am having to watch an ad on my own channel. Interesting. Guys, let me remind you, I did not put these ads over here at all. This is all thanks to YouTube. Hello, hello. 2 minutes to go. I did tell you, call me Pixel. It'll take these previous highs and take the liquidity and go down because right now there's nothing really happening, right? So the major reason for that would, what the hell, would only be the Fed news. It would only be the Fed news. So I think that's what can cause that dump. Hello. So we're waiting for 2 minutes, maybe. It's playing the most corporate music out there that's possible. Let's just wait and see what happens. I'm gonna give it some time because as soon as after these 30 seconds, just look at what's gonna happen. As soon as these 30 seconds are over, just have a look at the market once. Could be very interesting. Five, four, three, two, one. Look at that confusion in the market. Okay, let's have a look. Let's listen to what they have to say. Everybody's waiting for them. Oh, he's here. The boss man. My God. Ooh, come on, man.
Largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level.
Okay, guys, whatever he's saying, I just wanted to focus on the numbers that he's putting out. Okay, these numbers mean everything.
Payroll jobs of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing.
He's talking very mixed.
Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal.
Okay, this is bad.
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet.
Okay.
Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Oh my God.
Great. Thank you. Chris Rugaber says
He literally sounded that he's afraid of Trump, man.
kept his position at the White House even as he's joined the Fed board. This is the first time
maybe we
I
could
believe the
short
Fed's
gold,
board
but
has
it's
had
quite
someone with
risky, guys.
executive branch ties in decades.
Maybe we can short gold a bit, but it is risky because if you see dollar index is rising, it's going up like crazy. Bitcoin hasn't responded enough because he pretty much spoke exactly as per expectations, which should not have been the case because of the kind of situation the economy is in. It's just that the markets have been pricing this in and did the exact same thing.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation. Although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
It's certainly possible. We have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year.
Hmm.
Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible and that there may be effects on employment, but
Yeah,
I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply.
exactly,
And
exactly.
to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Yeah, there you go. He's talking sense.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level.
Now, guys, if you have any questions, if you're not understanding any specific thing about what he's saying, do drop them. I will try to answer all of them one by one. But essentially, he's talking about various aspects like economy, unemployment, employment rate, and how it directly or indirectly affects things, like the things that I explained to you at the start of the stream. And is it good for the Indian market? It is a neutral fact for the Indian market because a 0.25% drop in the interest rate was already priced in within the Indian market. You already saw Indian market behaving in a certain way, right? It had already priced this in.
To goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes
Uh-huh.
and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now
Bad
reacting
answer.
to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that
Told you.
warrants a change in
Shorting gold
policy.
would be good. This is like a very fast
Colby
move
Smith of
in
the New
gold we
York
have taken,
Times.
guys.
Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month.
He's pretty much bullshitting right now. He's literally speaking BS out of his ass. He is not making any sense at all. Look at it. Look at how gold is reacting to it. Ideally, it should peak up now, gold, because of the answers he's giving. I really sense confusion and fear over here because see, these meetings are less about specifics and more about projections, the way they project themselves, the way he behaves is much more important. If it feels he is being dishonest, markets will price that in as well. So everything is important of what he does. So through this, talk, gold will go down, but after this, the market will price in. Market should ideally price in a reverse pickup of gold. But the 0.25 BPS cut that has happened in the interest rate is actually good for the markets. It's actually every rate cut is supposed to be good for the markets in ideal scenarios.
And in terms of the unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has
These
more
are the
to do
Bitcoin buying prices
with
for us,
immigration than it
guys.
has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that.
Slowing in immigration, slowing in demand. Do you see that?
So, that's what I meant by that.
Follow up. Every year since 2015, the SEP has forecast that you
You
would hit
see
your
that?
target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that
At all.
suggest that the 2% target is not really achievable? And does this present
Good
any
question. Let's
credibility
see.
problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal
Gone, man.
over
Gone.
at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories.
I will explain everything, guys. I will explain the key points that he mentioned. Do not worry. Let me first listen to the entire thing. I'll explain to you every point in detail. We'll go
You can
back to
see
those
this.
pointers. You can note down the time frame as well, or the particular time that you saw or heard the news at. We'll go back to it and I'll tell you again.
Basis
Don't
from
worry.
tariffs,
If you have
but that
questions.
those will
But
turn
right
out to
now,
be
just
a
observe.
one-time price increase as opposed
Observe his words and observe the market movements. You can see the price over here on the top left as well.
to all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case
Hit the
for there
level
being a
just
persistent
before that.
inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed.
Okay, let me explain a few things about what he's saying. He's saying that right now, number one, in usual scenarios and ideal scenarios, either supply is the problem or demand is the problem, right? Money prices, it's all about supply and demand. So either the supply is the problem or the demand is the problem. In this case, both are the problem. So when he was speaking about demand, he accidentally said that since with the new immigration laws, the demand is a problem. He then corrected himself. Oh, no, no, no. I mean, demand is a problem. So he also knows that these immigration laws that the US is bringing up is not really the solution. It's like Hitler's solution to making Germany better. Blame some category. So Trump is trying to blame immigration in a way. Lots of nonsense politics is happening in America right now. Lots of racism against Indians is happening right now. And that normal people know that. Every smart individual knows it's just a ploy to soften the blow for Americans before their dollar collapses, because dollar has to collapse right now. Everybody knows that. Every smart person, every smart economist, everybody who can see and understand data and is not dyslexic knows that. So what he's trying to say in this meeting is, yeah, so our projection is that our goal of 2% inflation. Imagine, guys, the world's largest economy. Look at the gold. Look at gold. I told you. So this is going to happen now. So the world's largest economy in such a beautiful all-time high market with the interest rates at such a high level is still unable to control inflation. And they say inflation is not near our target and we are dropping interest rates. How will they control inflation with dropping interest rates? Well, if they drop interest rates, that means what? They need more money into the market. Why do they need more money? To bring the demand up. Well, if the demand goes up and the supply is not up, what happens? Things get expensive. Imagine if there are only three iPhones out there in the market and hundreds of people want to buy it. All right. Now, will the iPhones be expensive? Yes. Let's not even iPhone. Let's say some watch. It's a very low supply watch. Only two watches are there. But if there are 2,000 watches and only one person wants to buy it, it's like everybody would be willing to sell it for as cheap as possible. That's the game of supply and demand. So he's saying we need to increase both supply and the demand. So right now he's trying to increase the demand by dropping the interest rate, but then the supply drops. Supply is anyway bad. Things get more expensive. That's what's happening, and that's their problem right now.
And this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the
If immigration is low, there are fewer people who come and buy. That's the problem.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk.
You might
And that means
consider
there's no risk-free path. And so it's quite a
risky
difficult
Bitcoin short.
situation for policymakers. And it's not at all
Short
surprising
and
to
a
me
long. You
that
might
you
consider
have
a both
a
side
range of
position
views. It's not so much about
with
having
these
different
levels
views for the
as your
path of the
trigger.
economy,
Okay.
but it's partly that. But it's also partly about what's the right thing to do in light of of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
It's very positive for the dollar. It's bad for INR. If dollar index goes up, INR falls.
As markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, You'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to serve the American people.
He literally told that Trump and other political parties they care about elections. I mean, that's the truth. Everybody knows that, but him saying it on that platform, he doesn't give a shit
As we
now.
always have
He
now.
literally doesn't give a
And people
shit.
they're making their arguments, and we're having a great
He's
discussion around
punching
these
Trump
challenging
hard,
issues.
dude.
So
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Interesting.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
Okay, so he's saying a very important thing. So 911,000 jobs were removed from the database. Database in the sense, so every month US kept faking that they were adding 75,000 jobs that did not exist. And this is probably the largest ever job data revision in history. It's a really bad look on the US. It's the largest ever job revision, guys.
Good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But
Guys,
the data we get is
you can consider exiting majority of your gold short in case you took this. If you didn't, it's fine. It's just a news-based trade because we are near a psychological level plus our previous low. If it does want to go down, it'll consolidate for a couple more minutes and then fall. But it's a
response
good
rates, and
idea
we
to
need
book your
those to
profits over
have
here.
less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is
How much did you
in the
guys
case of the
make though in this trade?
job creation,
You made about
the response rate is
20-ish,
quite low
22
for the
to
first month, or lower
$24
for the first month. By the time you get to the second or
gold.
third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data; it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates
Hello,
should be?
Ganesh.
Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening.
Well, we'll keep analyzing these questions and answers later. But if you guys have any questions, I would love to answer them right now. Get your doubts solved and help you get financially smarter because this meeting will go on. The move has already come. The move that we wanted to capture about around 20. 2,700 pips, according to TradingView, is what we captured in this gold trade. If we just take the bottom of this, US dollar view, dollar, like I said, it's going to pump up because a rate cut is positive for the currency, it's positive for the economy. That means, sorry guys, it's 3 a.m. It's positive for the economy, and that means more money will flow into the economy. That's what it's about. Powell is the chairman of the Federal Reserve, my friend. He's the chairman of the Federal Reserve. But what if you guys have any other question, let me know. Else we can end the stream for now. Booked 600 USD. Amazing, dude. Congratulations. Are you in Indonesia? I'm in Indonesia. Yes. Is gold correlated with currency? Of course, absolutely. It's inversely proportional. If you look at this is the gold chart, and here's your dollar index. If the dollar index is going up, that means the gold will go down. It's inversely proportional to dollar specifically. So people either invest in dollar or in gold. That's how it kind of works. That's how it's kind of been working for a while. US crypto. I would love to explain that in a different video, Zoro. I will explain that in a different video. Don't worry. Bitcoin view, I already shared the view. I have already shared the level for buying Bitcoin. That would be around 114K. You can consider buying Bitcoin over there. In gold, we can buy or sell. We have already taken our exit in gold. I think it's time. I think the sleep fairy is calling me. But if you have any questions, do drop them in between after this video. Do drop those questions. I will try to create a video, a Q&A kind of a video on answer all those questions. Book 1000 USD in Bitcoin. Congrats, bro. Super, super happy for you guys. Now, again, I think gold is going for another short play over here. Did he say something? If this low breaks, I think it should be a sudden move, and this is technical analysis. This is not news analysis. If this low breaks, we'll get a very good move in gold. We should get one in gold. I mean, that'd be the technical analysis of it. It's a very simple setup as well. Is he scared of Trump? They're unrelated, man. If he was afraid of Trump, he would not be in US right now. His stature is too big to be afraid of Trump, man. He's the Fed chairman. Silver will go up,
The
no
black
doubt about it.
unemployment rate in August was above 7%, declining.
So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Chairman, Neil Irwin with
I mean,
Axios.
guys, I don't think you need to understand that. So a reporter asked, "Are you not open to an independent review?" They said, we." Oh, you thought this is out of syllabus. We are certainly willing to do better. This is such a shame, man. But man, guys, you gotta admire the man standing there at the podium doing such a bloody difficult job in his life, dude. He's supposed to answer these questions live in front of the world and not crack, not slip up. At that age, it's not easy.
There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand.
And the economy has
Well, guys, if you want a complete detailed video on this, make sure you like this video. We hit good number of likes. That's what we want from this. And then I would love to create another detailed video on this as well. So until then, have a good night, guys. I hope whoever traded on this made some really good money. And if you didn't, please do join us next time. We stream every day and we make money every day. If it might not be me, it'll be my mate Fahad, who is an excellent, a champion crypto trader. other viewers of the stream can vouch for him. So I hope you enjoyed watching Bitcoin Hit Point, guys. And for other crypto related information, do check out our channel. We have some really powerful videos. We do live streams every day. It should really help you make money absolutely for no cost, all just for one like, if that's not too much for us to ask for. So, good night, everybody. Have a good one. I'll see you again very soon.